Imagine having the power to naturally spot trading opportunities others might miss, all while simplifying your strategy. That's where the fair value gap trading strategy comes in. Understanding fair value gaps is essential for traders seeking to navigate the complexities of the financial markets. These concepts are deeply rooted in the smart money concept. Fair value gap is the specific event when a sudden increase of supply or demand of an asset causes a sharp price movement. This chart is a great example of a FVG. Because of the sudden spike of demand, the price bounced rapidly, forming a high momentum bullish candle. This chart is the perfect example of a fair value gap caused by the sudden increase of supply. Before going to the main part of the video, make sure to hit the subscribe button and hit the notifications bell so that you know exactly when new content is released. Also, let us know your questions and thoughts below, or video topics you want us to cover, as we always take them into consideration and love hearing from you all. There are various reasons why fair value gap occurs. The most common ones are the release of some important fundamental news that immediately change the market sentiment and cause significant buying or selling activity. Activity of institutional traders who open or close a trading strategy of a huge volume. Central bank interventions. One of the easiest ways to recognize a fair value gap is to learn a simple candlestick pattern. This candlestick pattern consists of 3 consequent candles. The patterns can be bullish or bearish. Bullish pattern will signify the excess of demand. It will be based on a bullish or bearish candle, followed by a relatively strong bullish candle, followed by a bullish or bearish candle. The level of the high of the first candle should be lower than the level of the low of the third candle. The space between these levels is a fair value gap. Bearish pattern will signify the excess of supply. It will be based on a bullish or bearish candle, followed by a relatively strong bearish candle, followed by a bullish or bearish candle. The level of the low of the first candle should be higher than the level of the high of the third candle. The space between these levels is a fair value gap. In both examples, the second candle in the pattern is a strong candle with a big body. It is the main element of the pattern, and a formation of such a candle will help you to easily find fair value gap. So, if you're enjoying the video and found it helpful, please leave a like on this video and comment, as it goes a long way and helps support our channel. We appreciate it. So let's get back to it. Fair value gap signifies a highly profitable shift in the market sentiment. A bullish FVG implies the dominance of the buyers on the market and a bullish continuation. Take a look how a formation of a bullish fair value gap triggered a strong bullish wave, while a bearish FVG implies the dominance of the sellers on the market and a bearish continuation. Always remember that the formation of a fair value gap alone, most of the time, will give a very poor signal. The FVG that is formed beyond the liquidity zones can easily be the manipulation. We have a dedicated video on the liquidity sweep trading strategy. You can find the link in the description or by clicking the I button on the video. When you spotted a fair value gap, make sure that it is formed with a liquidity zone. The liquidity zone below current price levels will be called a demand zone, while a liquidity zone that is above current price levels will be called a supply zone. The formation of a bullish fair value gap within a demand zone will give a very strong bullish signal. With a high probability, the price will go up then. Its formation triggered a strong bullish continuation. The formation of a bearish fair value gap within a supply zone will give a very strong bearish signal. With a high probability, the price will go down then. A bearish movement followed then. There are various strategies to trade FVG. One of the simplest ones is to open a trading position immediately after a confirmed formation of a FVG. But this method does not provide a good reward to risk ration. Remember that after a formation of a fair value gap with a high probability, the market will fill that. You can see that after a formation of a bullish FVG, this chart formed a strong bearish candle and filled the gap. After the gap gets filled, the market tends to start moving in the desired direction. For that reason, your best area to buy the market from after a formation of a bullish FVG is fair value gap itself. Set your buy limit order within. Stop loss will lie below the demand zone, and take profit will be based on the closest supply zone. And a nice profit was made. In this chart, you can see a bearish FVG after a test of a supply zone. Sell limit is lying within the FVG. Stop loss is above the supply zone. Take profit is the closest demand zone. After a fair value gap was filled, the price dropped to the target. Fair value gap is one of the most significant events in smart money concepts trading. Its recognition will help you to accurately predict the coming bullish and bearish waves and trade them safely. Now, if you guys enjoyed this video and found it helpful, please show your support by hitting the thumbs up button, subscribing to our channel, and turning on the notifications bell so that you can keep up to date with new content releases. Also, leave your questions and thoughts below. Do not forget to visit our website, fxtradinger.com.